Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Let's talk about an interesting article that comes out from Bloomberg. Basically says that the guy who created the Taylor rule says we need to see higher interest rates in the US. Now, who is this guy? His name is John Taylor. He created this idea, this theory called the Taylor rule. What is this Taylor rule? The Taylor rule basically states that in order to get inflation down, you need interest rates to go up, and not just go up like it did last year and also this year, but go up to a level where it's above the inflation level, the inflation rate. So if the inflation rate is 5%, you need to see interest rates go above 5% and keep interest rates there higher for some time above this inflation level in order to get inflation down to their 2% target. That's what John Taylor argues, that's what he's saying, and he came out recently saying that, hey, the Fed, yes, they hiked a lot. They hiked a lot last year, but that's not enough. They need to continue. They got to keep going with their rate hikes, and they got to do a couple more rate hikes in order to bring and tackle this inflation down, in order to fit their Taylor rule model. Now, higher rates, a lot of people would basically be in disgust to hear if that was to come true, and that's what the markets are pricing in, another rate hike this month and another one at the end of this year. So there's about 90% probability of a rate hike in July and about 30-ish, close to 40-ish% in terms of a rate hike for another one by the end of the year. Can that be ramped up? Could there be more rates further? Sure, if the data continues to be strong and resilient and you see that the economic growth continues to be strong and resilient, you'll get more. Now, John Taylor at the same time also said that the fiscal side of things, this is when we're talking about the government, continues to spend, continues to run deficits. And he mentioned generally central bankers, they don't really talk too much to the government, or they're not supposed to actually, according to the rules and the laws and what they say, they're not supposed to be influenced in any way, and they don't really, as we heard from Powell, tell them how to do their jobs. But you did get John Taylor basically come out and say that, hey, on the fiscal side, things need to slow down in order to avoid the risk of monetizing the debt, right? Because if they continue spending at the current levels, what they're spending at, that's one, you're increasing and making it difficult for inflation to come down. And second is that you've got a risk where the money is going to be gone, and then they eventually have to go to the central bank for more funding. And that's going to put the central bank in a very tough situation, which some people may argue that, hey, when that situation happens, then the printer goes burr, they're going to start printing again, more injection of money in the system, which is not good for inflation, because again, that keeps inflation sticky. It keeps it above the 2% target. So to avoid that, hey, government, slow down your spending, stop your spending, you're just adding more fuel to the fire. And that's what John Taylor basically says here. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.